What has truly drawn attention in this recent move of the dollar is not only the fact that the currency has reached its lowest level in the past 4 years, but the way in which this happened. It was not an isolated event, nor a reaction to a specific piece of news, nor a one-off market shock. It was a sequence of rapid, continuous declines that are hard to ignore, occurring at a time when, in theory, the U.S. economy should be projecting strength and stability. This contrast is the first major warning sign. Historically, when a currency weakens even in a scenario of apparent growth, the problem is usually beneath the surface. The dollar has always functioned as a thermometer of global confidence in the United States. When it loses value in this manner, the market is sending a clear message: something structural is being reassessed. In recent hours, institutional investors have begun to act with unusual caution. There has been no open panic, but there has been repositioning. Funds have reduced currency exposure, portfolio managers have adjusted allocations, and major players have started to hedge positions that were previously considered safe by definition. This type of movement does not happen on impulse. It happens when risk stops being theoretical and starts being perceived as real. At the same time, the market has begun to price in more strongly the possibility of significant changes in U.S. monetary policy. Expectations of interest rate cuts, combined with an increasingly strained fiscal backdrop, weaken the dollar's attractiveness against other currencies. When expected returns fall and risk rises, capital starts looking for alternatives. And that is exactly what is happening. Another relevant factor is the behavior of global investors toward U.S. debt. The level of indebtedness has reached historic highs, and the cost of sustaining that debt has risen significantly in recent years. High interest rates over a prolonged period make the system more fragile because they require the constant issuance of new bonds just to keep the structure functioning. This model depends on absolute confidence, and confidence is something that can erode. The international landscape also weighs in. The world is becoming more economically fragmented, with blocs seeking to reduce strategic dependencies. The centrality of the dollar in global trade remains enormous, but it is no longer as unquestionable as it once was. Small changes in agreements, reference currencies, and payment systems may seem irrelevant in isolation, but together they create an environment in which the absolute dominance of the U.S. currency begins to be questioned. Meanwhile, assets traditionally seen as safe havens have regained strength. Gold has started to attract large volumes of capital, not merely as a speculative bet, but as a store of value in a time of uncertainty. This movement rarely happens without reason. When investors seek protection, it is because they believe systemic risk has increased. What is most unsettling is that, outside financial markets, the general perception is still one of normality. Consumption remains strong, equity markets continue to hold elevated levels, and the official narrative keeps projecting confidence. But this disconnect between rhetoric and capital behavior often precedes harsher corrections. Money moves before the narrative changes. At this point, the discussion moves beyond numbers and becomes a question of credibility. The dollar has not fallen merely because it lost technical strength, but because the market has begun to reassess the fundamentals that have long supported its dominant position. And when this reassessment begins, it rarely unfolds in a controlled manner. From here on, the scenario becomes more sensitive, because it is not just about a weaker currency, but about an entire system operating on a level of confidence that is no longer unshakable. And when confidence starts to give way, even slowly, the effects tend to spread far beyond the foreign exchange market. When the world's most important currency begins to lose strength, the first place where tension appears is not in the headlines, but behind the scenes of the financial system. The weakening of the dollar starts to quietly pressure banks, funds, and major institutions, almost imperceptibly to those who look only at surface-level numbers. But those who follow internal signals know the system begins operating in defensive mode. In recent days, global financial institutions have started to reassess exposures that were previously considered safe by definition. Dollar-linked contracts, which for decades were treated as a stable foundation for planning, have begun to require constant adjustments. This creates a technical domino effect: higher collateral requirements, rising operational costs, and less liquidity circulating. The money still exists, but it moves more cautiously, and that slows everything down. This movement directly affects credit. Banks become more selective, companies face tougher conditions to finance projects, and consumers feel the restriction, even if indirectly. It is not an immediate shock, but a gradual tightening that often goes unnoticed until the effects become impossible to ignore. This is exactly how systemic crises begin to take shape, not with explosions, but with compression. At the same time, U.S. Treasury bonds, historically seen as the safest asset on the planet, enter a delicate phase. The safety of these securities has always been tied to full confidence in the dollar. When that confidence wavers, investors begin to demand higher yields to compensate for the risk. This puts pressure on interest rates, increases the cost of debt, and creates a dangerous cycle for the U.S. government itself, which depends on constant financing to sustain its spending. Another critical point emerges in the international market. Countries that hold large dollar reserves begin to question, even discreetly, whether it makes sense to maintain such a high concentration in a single asset. Small diversifications start to occur, not as a rupture, but as a precaution. The problem is that when many do this at the same time, the collective effect becomes significant. In emerging markets, the impact is even more sensitive. Economies dependent on foreign capital face currency volatility, capital flight, and inflationary pressure. Central banks are forced to act, often burning reserves to contain sharp movements. This weakens their defenses and leaves them more exposed to external shocks. A weak dollar, in this context, does not represent relief. It represents instability. Meanwhile, large multinational companies adopt a wait-and-see stance. Projects are postponed, expansions revised, and investments reassessed. Capital, which always seeks predictability, begins to retreat. This behavior does not immediately appear in growth data, but its effects accumulate over time, reducing the pace of the real economy. All of this happens without declared panic, without dramatic announcements, without alarmist speeches, and this may be the most dangerous aspect of the current moment. The system is still functioning, but it is functioning under strain. The gears keep turning, but with more friction. And when friction increases too much, some component eventually gives way. It is in this scenario that the discussion ceases to be merely economic and becomes structural, because what is being tested now is not just the strength of the dollar, but the entire architecture of the global financial system that was built around it. The possibility of a world less dependent on the dollar is no longer a theoretical exercise. It is beginning to materialize through small, seemingly isolated decisions that, taken together, outline a profound shift. Monetary hegemony is not lost through a sudden collapse, but through the slow erosion of the trust that sustains it. One of the most symbolic signs of this process is the change in behavior of the American investor themselves. The idea of keeping all one's wealth concentrated in domestic assets is increasingly being questioned. The search for international diversification, precious metals, and structures that offer protection against monetary devaluation is growing. This is not driven by fashion, but by risk perception. At the same time, political and economic discourse is undergoing transformation. Narratives that once defended continuous growth financed by unlimited debt are facing increasing resistance. The cost of this model is becoming visible, and the population is beginning to feel its effects indirectly, whether through the cost of living or economic insecurity. Trust, once shaken, does not easily return. There is also a collective psychological impact that rarely appears in reports. The dollar has always been a symbol of stability, power, and predictability. When that symbol weakens, even partially, it affects individual and collective decision-making. Families become more cautious, companies reduce risk, and governments find it harder to justify expansionary policies. The system as a whole slows down. In this environment, new alternatives gain ground. The discussion around multiple financial centers, agreements outside the traditional axis, and parallel systems is no longer marginal. This is not about immediately replacing the dollar, but about reducing its absolute centrality. The result is a more fragmented, less coordinated world, and paradoxically, one more vulnerable to shocks. The greatest risk now is not an immediate collapse, but complacency. The belief that the system will always find a way to adjust ignores an essential factor. Adjustments have costs, and those costs are rarely distributed fairly. Those who are less prepared tend to pay the price. The current moment represents a historical inflection point. It may not be remembered as the beginning of a major crisis, but as the period when the signs became too clear to ignore. The decline of the dollar in itself is not the end of anything, but it may be the most visible symptom of a much larger transformation underway. In the end, everything converges on a single issue: trust. The global financial system does not operate solely on numbers, interest rates, and contracts. It works because people believe in it. And when that belief begins to weaken even slowly, money is always the first to notice.